Hello, welcome everyone. Thank you for taking the time today to learn more about the CARES Act, which was signed into law by the President on March 27th. During this webinar, I'm going to be sharing information in regards to how the Act affected the interest expense limitation rules under 163J. Quickly, to cover the legal disclaimer, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. As a quick introduction, my name is Matt Montez and I'm a partner at Moss Adams. And I'm an industry group tax leader for the construction, real estate, and hospitality practice. Many of the provisions of the CARES Act are what I would call business friendly, and this provision is a good example. Businesses were previously and still are subject to interest expense limitations based on their operating results for the year, potentially creating a scenario where a deduction for business interest expense was suspended and carried forward to a future year. The tax law changes that resulted from the CARES Act generally allow for businesses to deduct an increased amount of interest expense as compared to previous law. In general, under 163J, the interest expense was previously limited to 30% of adjusted taxable income and interest income for the given year. Adjusted taxable income, much like many of the provisions of 163J, can be a complicated calculation. That being said, you might think of adjusted taxable income as akin to a tax basis of EBITDA. The CARES Act increased the limitation of interest expense from 30% of adjusted taxable income to 50% of adjusted taxable income. This increased threshold is applicable for tax years 2019 and 2020. It makes sense then that businesses will be able to allow as a tax deduction an increased amount of interest expense and hopefully reduce their overall tax burden. Another taxpayer-friendly change is that in preparation of the 2020 tax returns, businesses will be eligible to base their interest expense not on their 2020 adjusted taxable income, but rather their 2019 adjusted taxable income. This will certainly help those businesses which experience a reduction in adjusted taxable income in tax year 2020. As with many of the nuances of 163J, the interest expense limitations get a little bit more complicated with entities filing as a partnership. Partnerships' 2019 tax returns will continue to use the 30% limitation against adjusted taxable income. And rather, the shift to the 50% limitation will be applicable for tax year 2020. This delay is likely a result that many partnership returns have already been filed for tax year 2019. As 2019 partnership returns are still required to use the lower 30% limitation, they are awarded special treatment come tax year 2020. To the extent a partnership had suspended interest in 2019, or what is called excess business interest expense, that excess business interest expense in 2020 will be 50% deductible and otherwise not subject to the 163J limitations. And the remaining 50% will be subject to the 163J deductibility rules. On April 10th, the IRS released Revenue Procedure 2020-22 as a guidance regarding elections out of the 163J interest expense limitations. Certain taxpayers that either are electing real property trades or businesses or farming businesses are eligible to elect out of 163J. This revenue procedure allows certain taxpayers to make a late election or withdraw an election on an amended 2018 or an amended 2019 tax return. As a consequence of making the election, real property or farming businesses are required to calculate depreciation under an alternative method of depreciation called ADS. Under ADS, the lives of assets are generally only slightly longer than they would have been under the maker's lives. However, under ADS, bonus depreciation is not available. As the CARES Act made a technical correction to the Qualified Improvement Property Rules, or QIP, and is also allowing this change to be made retroactively to 2018, the real property or farming business election out of 163J is important to consider. Please note, as these rules are applicable for tax year 2019, this change in tax law may impact tax returns that have already been filed this tax season or in the process of preparation now. Changes to the 163J rules should be coupled with other changes of the CARES Act to consider and model the most tax advantageous approach to tackling the interest expense limitation rules. Modeling the impact should include, but be not limited to, the increased adjusted taxable income limitation for 2019 and 20, The ability to revoke previously irrevocable elections or make late elections for real property or farming businesses, the changes to qualified improvement property designations, which are now eligible for bonus depreciation, and the changes to the net operating loss limitations. This tax law change should prove beneficial to many taxpayers. While there are many acronyms used here and nuances to the rules, we highly encourage you to reach out to your Moss Adams professional as to how this change might impact you and your business. Thank you very much, and take care.